Hello and welcome to the podcast of the Central Bank of Nigeria. I'm your host, Ejike Agu, and today we'll be talking about the 2024 Banking Sector Recapitalization Program. My guest is none other than Mr. Haruna Mustafa, a career central banker and the current director of the Financial Policy and Regulation Department. Thank you for joining us today, sir.
Thank you, Ejike, for having me.
Now, as far back as 2004 and 2010, we've had similar banking sector reforms. And now with the new current program, can you give us an overview of this most current one under the leadership of Governor Olayemi Cardoso?
Thank you once again, Ejike. You're looking good.
Thank you, sir.
Well rested after the Easter holidays.
Well, I got enough sleep because I knew this was coming.
Exactly. So, the Banking Sector Recapitalization Program, as the name suggests, is an initiative or policy of the Central Bank of Nigeria that requires commercial, merchant, and non-interest banks to raise their capital relative to their different classes of authorization. The overarching objective here is to strengthen the Nigerian banking system, especially against the background of the prevailing macroeconomic challenges and headwinds that we're currently witnessing. Under the policy, we set out two broad objectives. Number one is to enhance the solvency and resilience of banks, to enable them absorb current and unexpected shocks. And this is speaking to the traditional function of capital, which is to absorb unexpected losses. And this is very, very important because capital is at the very core. It's one of the key metrics that regulators, supervisors use in assessing the soundness of banks. The second objective is to reposition the banks to continue to support the growth and development of the Nigerian economy. And this is in the context of the current aspiration to achieve a $1 trillion economy by the year 2030. And banks play a very critical and pivotal role in this regard. So these are the two broad objectives. And under the policy, banks are expected to achieve the minimum requirement through multiple pathways. Banks may opt to inject fresh funds through rights issue, like I said, private placements, or you can go to the capital market through public offerings. Banks may also opt to go through what we call mergers and acquisitions. They can downgrade their current license authorizations or even upgrade, as the case may be. The different capital requirements reflect the different risk profile, size, and license category of the banks. So just to give you a little flavor of what these requirements are. For international banks, the current capital requirement is 50 billion, and under the new requirements, international banks are expected to hold 500 billion naira in capital.
It's a big jump.
Quite a big chunk, I must say. National banks are currently at 25, and under the new policy, they are expected to hold 200 billion naira. Merchant banks are currently at 15, they are expected to hold 50 billion. So the list goes on and on, all the way to the least non-interest bank, which is a regional bank, holding 10 billion, up from 5 billion. The whole idea, the overarching objective is to strengthen the banks and put them in a position to be able to support the growth of the economy. Now, banks are expected to meet this requirement, I mean, in terms of the definition of this capital requirement, is supposed to comprise paid up capital and share premium. I'm very sure a lot of people will be wondering, why did the central bank exclude other reserves, particularly retained earnings?
Yes, it's a hot button question.
Exactly. I'm going to address that in a short while. But suffice it to say that what we are doing is in the ordinary discharge of our routine responsibilities. The central bank, from time to time, prescribes capital. And this mirrors regulatory practices all over the world. You recall a similar exercise was done in 2004, 2005, when we moved from 2 billion to 25 billion. So this is something similar. And you also recall what happened back then. The central bank was very proactive. Little did we know that the global financial crisis was going to hit just 2-3 years down the road.
Yes, in 2008,
2007, 2008.
Sure.
And we all can relate to the deleterious consequences of that episode. The whole idea is to ready our banks, especially in the context of the prevailing macroeconomic shocks that are both exogenous and also domestic. As a risk-based regulator, we will be remiss in our regulatory duties and responsibilities not to take some proactive steps. And that is precisely what this is all about. Exercise is supposed to span a period of 2 years, commencing from the 1st of April and terminating on the 31st of March 2026. So it's sufficient time for banks to be able to meet the requirement. And like was stated in the circular we issued, so we are optimistic that at the end of the program, we are going to have stronger banks. We are going to have a healthier banking system, a more resilient banking system that can withstand future shocks.
For the regular Nigerian citizen who maybe has to go to his bank, how will it affect interest rates on on taking out loans or savings accounts for everyday Nigerians?
In terms of the direct impact on customers, the program will not in any way negatively affect customers' ability to be able to conduct daily transactions with banks. But in terms of whether it will affect interest rates or the cost of borrowing, now, when banks have stronger capital, they are in a position to be able to deliver a variety of products and services that can lead to better customer experience. But in terms of whether the new policy will affect the cost of funding or the price of, the interest rates, not at all. But it is going to have a positive impact in terms of banks' ability to be able to operate more efficiently and also be able to sustain their operations.
All right. Well, I guess that this would be a good time for us to go back to the particular reasons why the shareholders' retained profits was excluded. Can you maybe touch a bit more on that for our listeners?
To address that question, let me just highlight two important points. Number one, Section 9 and Section 63, subsection 2A of the Banks and Other Financial Institutions Act 2020 empowers the central bank to determine the period of capital of banks and also the timeline within which banks should comply with those requirements. It also enables the central bank to set the level and quality capital that banks should have. And this is without prejudice to what should constitute the shareholders' funds of banks. What the central bank has simply done is to ensure that banks inject fresh equity, fresh capital. Don't forget, banks are in the business of financial intermediation, and this comes with risks. And the capital is there to absorb some of these risks or losses that may arise from their operations. And to put this in better context, let me just take you back to 2004, 2005 again, when the central bank raised the minimum capital requirement from 2 billion to 25 billion, it elicited similar reaction. There was so much hoopla. Why should we go that drastic? But looking back, like they say, hindsight is 2020.
Yeah.
Was the central bank prescient? Did we see tomorrow when we raise it? Because 2-3 years down the line, the global financial crisis hit. And back then, we had a motley crowd of 89 mostly big banks. Banks that could not fund big ticket transactions unless they came under a club or syndicate arrangement. That didn't bode well for the sustainability of the banks and indeed the banking system. So what did the central bank do? We raised the capital requirement to strengthen the banks and position them to play on the global stage and also to support the growth of the economy. Now, but for that singular action that we took, when the global financial crisis came, especially the second round effect, the banking system would have been badly hit with deleterious consequences for the economy. But that saved the day. And that was what ushered in or heralded the banking sector consolidation that led to the emergence of 25 strong banks. And we're all beneficiaries of the positive fallout of that policy. Nigerian banks could then play on the global stage. Today, you have Nigerian banks with footprints across continental Africa and even Europe and the Americas. This is partly thanks to the foresight of the central bank in introducing the banking sector consolidation program. So back to the question of the exclusion of retained earnings. What we have simply done is to nudge the banks to inject fresh capital. And this is without prejudice, like I mentioned, to what the different components of shareholders' funds will be. And like we have stated in our circular, shareholders' funds, other reserves will continue to be recognized in the computation and determination of banks' capital adequacy ratio, which is an important metric in our assessment of the soundness of banks. So it doesn't detract from what the capital adequacy of banks should be. And we are not changing the definition of capital. What we have done again is akin to a vaccine shot. You know, you all recall our experience during the COVID-19 situation where almost everybody took a vaccine shot.
Very trying times.
Yeah, yes. Very trying times. And some people even went for a booster shot. So this is like your own booster shot, if you like. You know, yes, the banking system is safe, sound, and resilient, but we can do with more capital to enhance and further strengthen the banking system.
Will that have a run-on effect of maybe even stabilizing the FX market?
This policy holds enormous promise and opportunities, not only for the banking system, but for the wider economy. We expect to see massive inflow of foreign direct investments, and these are patient funds that any economy will need for long-term sustainable growth. Because one fundamental challenge for our development story is the absence of long-term patient capital. This is going to lead to the inflow of foreign direct investments. We're looking to see investors coming in to take position in our banking system. If to the extent that we have more FX inflows, to that extent is going to have a salutary impact on liquidity in the capital market, the FX market,
yes.
And which will also have a concomitant positive impact on the exchange rate. It's just simple demand and supply.
Very true.
And this will be complementary to ongoing reforms by the central bank to ensure that we achieve stability and credibility in the FX market. So, if you like, this policy, to my mind, is like a silver bullet that will help in achieving multiple objectives. And so that is the end goal. And at the end of the day, we see banks being able to support the growth of the economy. And just to put this in bold relief, and I'm very sure the banks will also relate to this, capital is critical, not only, like I mentioned, in terms of their ability to be able to absorb shocks, but even in terms of their ability to be able to operate. In supervisory parlance, we have some metrics that we use in restricting or limiting banks' risk exposures. So I give you one example. There's what we call single obligor limit, which is a function of capital. So banks cannot lend to a single borrower in excess of 20% of their shareholders' funds unimpaired by losses. Now, what that means, to put it in layman's language, if I wanted to lend to a promising customer, like a quote-unquote, one of the oil majors, for instance, I'm hamstrung if my capital is not sufficient to meet his needs. And that does not bode well for the sustainability of the banking system. So that is what we are trying to, one of the things we're trying to, achieve. So if banks cannot lend, especially profitable, take advantage of profitable opportunities, then it becomes an issue in terms of their long-term growth and sustainability. And that could have a knock-on effect on their bottom line, which will also have a knock-on effect on their capital. So there's a sense in which these dots connect. And so this is very important. And I'm very sure some years down the line, we'll all look back and say, thank God we did it.
Or there's questions about maybe this might slow down GDP too much in the maybe short, medium term. How has the CBN as a regulator been able to maintain or monitor the dials?
Talking about contribution to GDP, I mentioned the pivotal role that banks play in any economy. Now, for them to be able to effectively play that role, they need to be robustly capitalized to be able to support the growth of the economy. To the extent that banks are able to effectively perform their intermediation function, to that extent, are they able to contribute to economic growth? Think about the different economic players that will access credit, for instance, and think about the multiplier benefits that will accrue. Manufacturers, other economic players, and also the job opportunities that will be created up and down the value chain.
So big infrastructure projects
precisely
require bigger capital.
Bigger capital. And I also, drew your attention to our experienced during the consolidation program, and we've all seen the benefits. So things are changing in very fundamental ways, and we need to really keep pace with some of these developments. And this is part of the suite of reforms that the central bank is currently powering to ensure that we have a strong banking system, a resilient banking system that can support the growth of the economy and that can also work for Nigerians. With this, and complemented by other reforms, it is just a matter of time. We'll begin to see the benefits manifest to the glory of our country and to the benefit of all.
Now, leading up to this as well, with the CBN being, the regulator and supervisor for all the banks in the banking sector, was there a collaboration with these banks for the creation of this new program, or was it a surprise?
If you recall, the governor announced plans by the central bank to raise the minimum capital requirement of banks back in November 2023 at the Chartered Institute of Bankers annual dinner in November. So that was just by way of heads up. And that was an event that was attended by the entire banking community in Nigeria and other stakeholders, to the packed hall of bankers, the creme de la creme of the Nigerian banking community, so to speak. That is one point of engagement. But moving on, at the recent Bankers Committee meeting, the governor also raised the issue. The issue was discussed, and the banks are fully aligned. They anticipated the increases. A number of banks had even started making their plans to raise capital, given the announcement by the central bank. And don't forget, in terms of consultation, there's this regular engagement with the banks in terms of how they meet their capital, whether they meet their capital requirements or not. This is, routine, engagement that we have with the banks.
Oh, okay.
That through reports, through our day-to-day, interactions. So in terms of engagement, I think there is sufficient engagement. But in terms of the exact numbers, that we ruled out, that was a closely guarded secret. But to the extent that central bank gave the heads up way back in November, and since then, we've seen various write-ups, including in the media, people speculating what the new capital levels will be. I think the only surprise will be the exclusion of the retained earnings and reserves. But I think the banking community anticipated this. They looked forward to it. And now that the cat has been let out of the bag, I think what remains now is for banks to roll up their sleeves and get down to the arduous task of raising the new capital requirement. I think a lot of banks have since moved on, trying to ensure that at the turn of the deadline.
I like that. I couldn't have said it better myself.
Sure.
Thank you so much for joining us today, sir. It's been a real pleasure.
Thank you for having me.
And that concludes today's episode of the podcast. Thank you for joining us.